Imagine two ships. One is brand new, fully equipped, and cruising smoothly. The other is old, missing key parts, and barely staying afloat. Now, if both were selling for the same price, would you really buy the old one just because it's also a ship? Probably not. Yet in the stock market, investors sometimes make that exact mistake, paying the same price for companies of very different quality. That's where the price-to-book ratio, or PB ratio, comes in. It helps investors figure out whether a stock is priced fairly compared to what the company actually owns. Hey there, this is Smart Money, where complex investing ideas are broken down in simple, practical terms. But before we dive in, a quick disclaimer. This video is for educational purposes only and should not be taken as financial advice. What is the price-to-book ratio? The PB ratio compares a company's market value to its net worth. Here's the formula. PB ratio equals market price per share divided by book value per share. The book value per share represents what would be left if a company sold all its assets and paid off all its debts. For example, suppose Company A has $100 million in assets and $40 million in debt. That means its book value is $60 million. If it has 10 million shares, the book value per share is $6. Now, if each share trades at $12, then PB ratio equals 12 divided by 6 equals 2. That means investors are paying twice the company's book value. What does the PB ratio tell you? Below 1, the stock trades for less than its book value. It could be undervalued, or signaling deeper issues. Around 1, the stock price matches its book value, likely fairly valued. Above 1, investors are paying more than the book value, usually because they expect future growth. Let's take a few examples. Tech giant Corp. PB ratio of 10.5, investors pay a premium for its software, brand, and innovation potential. Classic Furniture Co. PB ratio of 0.7, lots of tangible assets but low investor confidence in its future. Steady Bank Ltd. PB ratio of 1.2, typical for banks, which usually hold tangible assets like loans and cash. When is the PB ratio useful? The PB ratio works best for asset-heavy businesses like banks, real estate firms, or manufacturers, where assets are easier to measure. It's less reliable for tech or brand-driven companies whose value comes from ideas, intellectual property, or customer trust rather than physical assets. A real-world lesson. During the 2008 financial crisis, many bank stocks had PB ratios below 1. They looked like incredible bargains on paper. But behind the numbers, their balance sheets were full of risky assets that weren't worth what they claimed. When the truth came out, some banks collapsed, like Lehman Brothers, while others needed government bailouts. The lesson? A low PB ratio doesn't always mean a stock is cheap. Sometimes it's a red flag. Always understand why the ratio is low before investing. A simple analogy. Think of the PB ratio like checking a house before you buy it. The price might look great, but you still need to know what's inside. The structure, the neighborhood, and the potential. A stock works the same way, numbers are just the starting point. How to find the PB ratio? You can easily check a company's PB ratio on Yahoo Finance. Just search for the company, go to the statistics section, and scroll down to find the price-book value. Take Coca-Cola, for example. Its PB ratio is above 10, not because of its physical assets, but because of its powerful brand, distribution network, and consistent profitability. Final thoughts: each company is unique. The PB ratio is a helpful tool, but it shouldn't be used alone. Combine it with other metrics like PE ratio, EPS, and debt levels to make smarter investment decisions. If you found this video helpful, hit that like button, subscribe to Smart Money, and turn on notifications so you don't miss future videos. I'll leave another insightful video here that you'll definitely enjoy. Thanks for watching, and see you soon.